My name is Robert Amato, and I'm the principal here at Compass Wealth Management. Today, I plan to provide a brief overview of a custom risk management strategy we call an equity hedge that we have implemented in our clients' portfolios. For those of you watching who may not be clients, it's important to note that we are fee-only fiduciary advisors. The equity hedge investment I will be discussing is not a product solicited to our clients. It's a strategy we source and customize for our clients without any commissions, loads, or internal expenses. Now let's look at how this hedge investment works. The chart you see now shows an example of a hypothetical $100,000 initial investment at a starting value of 6,000 points on the S&P 500. We'll call the index. It has a defined payout amount based on the ending value of the index following a 2-year term. It is important to note that in any hedging strategy, there is give and take, meaning you give up a segment of return to gain another segment of return we believe is currently more favorable. What you give up in this investment is any ending index value greater than 20%, meaning your return is capped at 20% even if the ending index value is up higher. In the chart, we use 30% as an example. However, what you gain is a range of possible outcomes from an ending index value up 20% all the way down to an ending value down 20%, with the exception being a flat index ending value. To be clear, this means if the ending index value has gained an even 10% or 20%, your $100,000 principal investment would pay out either $110,000 or $120,000 gain. And if it drops 10% or 20% at the end of the term, your $100,000 principal investment will still pay out $110,000 or $120,000 gain. The math works for every percentage in between. Lastly, if the ending index value happens to drop below 20%, although you cease to achieve a positive return, you are still afforded a 20% buffer from these extreme ending value returns below 20%. We use an ending value of down 30% in the chart to illustrate this. In summary, this risk reduction strategy enables us to reduce equity risk without having to time the market, which is very hard to do consistently, even for the most sophisticated investors. Thank you for tuning in.